Hey guys, welcome to the Forex market research video. My name is Alexander Nikitin, and in today's video I will talk about the portfolio performance of a unified Gartley that was found with a pips based algorithm. So when I say pips based algorithm, first it is the algorithm that is based on pips value. For example, everything with this euro dollar, yes, everything that is less than 45.5 pips is simply ignored. If you have the movement in opposite direction to 45.5 pips, then it is something that makes sense. Okay, everything that is less is noise, and of course the movement for every pair is different. Why the pips is different for every pair? Because they are based on my research, and I call it the swing research. So what I did, I simply calculated the average swing distance with different algorithms on different time frames for different pairs. You see them? Okay, so these are different pairs, and I calculated the average impulses and average corrections for every pair as well. So for pound yen, the minimal correction is 86, so what is less is simply noise. So Aussie dollar is 36.8, Euro yen is 58.9, and so on. And I took this average minimal correction, yes, as my filter to filter everything that is less than that. And that's why we have it for different pairs, the average correction. So the Aussie dollar is this one, 36.8. After that, I went to my MPS5 pattern recognition software. I go to settings here, yes, I go this. I choose the algorithm out of 11 algorithms. I choose pip distance algorithms, and then I go to specify my pip distance. Here for Aussie dollar I specified as 36.8, so it draws swings as the 36.8. So if you are interested in these swings, let me show them. Okay, so the swings look this way, they are drawn on the chart automatically, and then the software calculates the patterns. So the pattern that I was testing is a so-called unified Gartley pattern. It is the pattern that I created. Basically it is the pattern that unites the features of both Gartley pattern and a BAT pattern. So you can see when I have them, one of these patterns actually is displayed because it fits both rules. If you are interested in the exact settings of this pattern, what are exact ratios for this pattern? They are very simple: minimal B point, maximal B point. The C point is standard, completion is 786, and invalidation 105. So this was my pattern. I also used an active trade management. So you see the number of take profits here, the number of stop losses distance. Initially the entry is a limit order here and stop loss is here. If price moves to hit this distance, which is half of stop loss distance, then the stop loss is moved to cut half. If it moves further here, then the stop loss is moved to break even and half position is closed here. If it moves further, then the rest of position is closed. And of course, if it reverses, then it may hit half, or it may, if it goes straight through, it hits full stop loss, and so on. And sometimes it hits the first target, then reverses, then we'll have first target win and the second target 0 because of break even. These are the details of the trade management. Okay, and then what else? Well, that's it about this. So what I want to show you today is the difference between two algorithms. So this is the pips based algorithm, and if we take my another Excel spreadsheet, the same pattern with the same rules, but guys with slightly different algorithm, and the algorithm was it's not here. It is a Prax algorithm, price extreme 10. So you can see what is the pound dollar result here, and what is the pound dollar result here. Yes, you can see the difference that between the algorithms. So whenever you have I don't know, whenever you have a discussion to some traders that this pattern should have this ratio and this pattern should have that ratio, before that you should specify the swing identification algorithm, because it has enormous importance of what swing identification algorithm you use. Simply having the same pattern with same targets, same stop losses, you would have different results if your swing identification algorithm is different. And of course there are as many swing identification as there are traders. Some traders use this, some traders use that. If you want to stay absolutely objective, you should switch between the algorithms to see how the pattern is seen by other traders, and if majority of algorithms coincide and say this pattern is okay, then this is most likely something that would work. Well, these are details. If you are interested in the software itself, you can go to visit my website www.ps-software.net and watch the video demonstration of that. So the video is here. So the introduction video, how to prepare platform, and so on. The algorithms, they are all explained, all 11 algorithms explained. Then you have the patterns, all the patterns explained. There are two types of patterns, two groups of patterns. Then there are filters, and then the pattern trade assistant robot that will trade according to these patterns. It is absolutely, this robot is given for free. Expert Advisor is given for free to all my customers. Here it is called the pattern trade assistant. Okay, now let's go back to the results. Let us start doing the calculation. So what I want to do is simply do the total result to see how it performs totally. I already have numbers because all results are added, and I already sorted them from oldest to newest. So we have 5 January 99 as our oldest, and we have 18 September 2018 as our newest trade. Okay, so what I will do today? Today we will use some money management techniques to see how we can turn our pips into money, and what is the best way to turn our pips into money. Okay, the pattern is giving you pips. Yes, you should turn it according to your money management. Let us start from 10K account. 1, 2, 3. So your initial 10K account. The first very popular technique is fixed position size. This is very popular. Scott Carney is using a fixed position size. Trade Empowered guys, Akil Stokes, Jason Stapleton, Charles Mars, Jason Greystone, they are all using fixed position size. Okay, now let's calculate what is better, if it is okay to use a fixed position size. Well, when you are using a fixed position size, it means that a fixed amount of dollar equals to your pip. For example, if your position size is 0.1 lot, let me type it, 0.1 lot, it means that you are risking $1 per pip, roughly. With yen pairs, of course, it is a bit less. With pound pairs, it is a bit more. Some crosses are less, but on average, you are risking $1 per pip. And if you have generated $100, automatically you generated 100 pips if you are using this position size. Of course, if you multiply by 10 and you use one standard lot, it will be this, yes. If you use a micro lot, it will be this, yes, and so on and so forth. So it all depends on your position size. When we will change our position size, I will explain you in a second, of course. how we calculate our initial position size to start from. Our initial position size is calculated this way. First of all, this is the portfolio largest drawdown. Largest drawdown with target 1, largest drawdown with target 2. So total largest drawdown is 1695. So let us type that. So largest drawdown is 1695. Perfect. Then we decide that, let me type it this way, largest drawdown. Then we decide that our largest dollar drawdown should be, what number would you prefer? Would you be okay to risk 30% of your account? Okay, so largest dollar drawdown would be calculated this way. 0.3, it represents 30%, multiplied your account. So what is the number? It is $3,000. Yes, and then let's calculate your risk per pip. What is your pip value? Risk per pip, how much you risk per pip. So it is very simple. You just divide your largest drawdown available. So if you allow yourself to risk only $3,000, so you divide it by the largest number of pips, and your position is this. Your risk, it's not your position yet, it is your risk. So it equals this, 3,000 divided by largest drawdown. Okay, it is 1.77. You cannot use that precise position size with 1.77, so you can use 1.8. So it is 1.8. Okay, and what is it in position size? What should be your position to risk 1.8 in each and every trade? So your position size should be this, 0.18. You see, when you risk 0.1, you risk $1, and when you risk 0.18, you risk $1.8 per every pip. So if you generate 100, you just multiply this by 100. If you generate 1,000 pips, you multiply this by 1,000 pips. Very, very simple. Okay, now let's do it. Let's turn the pipsage into money. We know that every pip equals to $1.8 with our money management technique. So let's calculate them all together. So it equals your initial position, initial account, plus we will add the result to this account. So result number 1 is this number of pipsage. Convert that pipsage into dollars, plus result number 2 pipsage. Converted this pipsage into dollars as well. Okay, now we'll go here and we'll do some upgrade of that reference, so it only points to the reference of our risk per pip. You see, it is violet, and it is violet as well. The color is violet. Okay, so what is left is simply stretch it to the downside. So in the end, after 18 years roughly, we have generated 40k, multiplied our account 40 times. Is it okay? Let us see. Let us have a visual representation. So we just choose that all. We go and build a graph. So this is the graph. Control X. Let's have here Control V. So here's the graph. Obviously we don't have drawdowns more than 30%. Yes, we have some drawdowns, but they are not more than 30%, exactly what we wanted in our money management. Yes, so it is exactly what we wanted. Now guys, let us do the money management calculations. So the money management rule says if you double your account, then you double your position. So if you double your position, of course your risk will be doubled. Risk per pip will be doubled. Now let's go to double our account after we double our position after we double our account. So double account equals to this. It is 20k. So next trade we double the position. Multiply 2. Multiply 2. Perfect. Then we just copy it to the downside, yes, to the rest. Okay, let us double our account when we double our position when we double an account. 30k. Then we go to have 40. So this is 40k. Yes. On the next trade we double our account. Just not account, we double our risk. One more time. So I hope you all agree with this formula. So we just doubled what we doubled. Then let's go to see if we can double our account one more time. Double our account one more time. So what we'll have, we need to have 80k. 80, 71, 72, 3. So 80k appears here. On the next trade we double the account, the risk. Okay, so we double the risk and then we go to the rest. So totally we ended with this number, 79k and blah blah blah. So what we did, we multiplied our initial account by 8 times. Wow, okay. Now let's calculate the drawdown formula, and I will call it this way. This is, it looks this way: fixed position drawdown. Okay, so the drawdown formula looks this way. It equals if the cell that I'm looking at right now is more or equals to maximal on my equity curve that I had before. Oh, come on. Maximal on my equity curve that I had before that, then I don't have any drawdown, of course. Okay, so what is the maximal on my equity curve? It is this one, yes? It is the highest peak. And suppose I am here. So it will always stay the same until I install the new maximum. The reference should be this. Okay, else I should calculate the difference between my highest peak and my lowest peak. So it should be this. The difference should be in brackets, and this is my initial minus the maximal. Control C. This is the difference. And if I want to learn that, to know what is the number in percentage, of course I should divide it by the maximal. Okay, so this ugly looking formula is actually one that is calculating your drawdown, and it is in percentages, of course. Now let's create the graph. Let's go to insert the chart, and let's cut this and insert here, for example. Yes, so now we have the largest drawdown that is touching 20%. Basically it is what we wanted. It is not more than 30%, but we have some room, yes, to increase our position slightly. So let's do it. So we have 1.8. What if we start from $2 per pip? Maybe 2.5 would be okay. What if we start from this, slightly increasing that? And of course we need to recalculate our money management. We will hit our 20k a bit faster, yes? So we go here. This is the first time we hit 20k. This is the first time we need to double it. So we multiply by 2, and then we multiply by 2. Okay, then we change the rest to this. Of course, we would also double our account a bit faster as well. So we will also hit 40k a bit faster here, and on the next trade we double it once again. Multiply by 2, multiply by 2, simply double what we have. And of course we hit our 80k a bit faster as well. I'm increasing the position size. Okay, so it was this one. First we hit this, and the next trade is this. So we multiply by 2, and then we multiply by 2. Then we should double that one more time, and it should be 160k. 160k. 100, 20, 30, 40. Okay, now it should be there somewhere here. 47, 45, 50, 160. Okay, here it is, 61, and on the next trade we double it. Double it one more time. Double it one more time. Double the risk. And what is the total result? Okay, almost 200k. 200k. It was 200k, but right now it is almost 200k. A small drawdown at the end. And what is the drawdown right now? It is slightly below 30%. So this number is a bit more precise. So the risk per dollar per pip should be this: 0.5. 0.5. Oh, sorry, 2.5 dollars of your this. If you wish to calculate something that is let's say that is ratio based, yes, so if you have 10k on your account, you should risk, so it equals this divided 10k, and let us use it this way. So for your position size to stay within the 30% drawdown, you should risk 0.00025 of your account. So let me type it for you. It is 0, then we have 1, 2, 3, 25 of your account per 1 pip. So this is your risk per 1 pip at this number. And of course, so let's have this number. It equals 0.12325. Yes, and this should be your account multiply this. Yes, so this is your risk per play. And if you change your account, this would automatically change. So let's say we have 37k account as our initial, and of course this number would automatically change, total number would automatically change, but the risk drawdown stays the same because of the ratio. You see that? So it now all depends from what you start from. This is the ratio of that. So regardless of what account you start, let's say 5k, it would be this initial, and then doubled every time it is doubled. And again it stays within the 30% sorry, maximal drawdown. Based on this largest drawdown, of course, based on this portfolio performance. Okay, Now once we have the ratio, you can find your position size easily. Yes, just multiply your account by this and use it until you double your account. Of course, your second position will be this multiplied twice, and so on. Okay, very simple for fixed position size calculations. So we have it this way. Maximal drawdown was almost 30%, and we generated 200k. 200k multiplied our account how many times? 200 times? No, 20 times. 20 times. Multiply the account 20 times. Okay, now let us calculate the average annual return and average monthly return. First of all, we need to calculate how many years we have in our backtest. So we start from January 99. Okay, it's okay, and we end September 99. 18 September 18. So totally, let me figure it out, we have 18 total years, yes, and 9 months. So what is 9 months? It is 3 quarters. Yes, 3 quarters. So we have 18.75 years. 18.75. 18 full years and 3 quarters. Agree? Yes, why not? So years, we have years 18.75, and let's convert that into months. How many months we have? It is very simple, just multiply this by 12 and we have 225 months. So you see, it is very simple calculations. Multiply by 12, 225 months. Okay, now let's calculate the average annual return and average monthly return. So the average annual return is calculated this way. So it equals, oh, the formula is a bit large. It equals what we ended with, this one, yes, divided by what we started with, and then we should raise it in power of 1 divided the number of years. If we are calculating the average yearly return, the number of years, and then we should use it minus 1. So this is the average annual return on average. Average annual return. Let's convert it into percentages maybe, yes, so you have it better. So on average, every year we were generated 17.28, and because of the compound percentage, yes, next year we were having a greater number, next year a greater number, next year a greater number. This 17.28 annual return multiplies our account 20 times over the period of 18.75 years. You see that? 20 years. And what was our monthly return? Yes, average monthly return. Monthly return. So I will simply calculate this formula, copy this formula, copy it here, and I go to paste it here, and instead of years I will convert into months, this one's. Okay, so the average monthly return is basically 1.34%. Because of compound percent, every month you have a larger number, larger, you have it parabolic move. This is a compound percent. So if you meet somebody saying that I had doubled my account, it means I have 2000%, and 2000% over the period of 20 years, it equals to 100% every year. This is bullshit. What 100% a year? If you have 100% a year, because of compound percent, you should become a trillionaire. 17% a year. If you 20 times multiplied your account during the period of 20 years, then you are having 17% a year. Okay, now let us use the second money management. So this is the fixed position size. I remind you that it is used by Scott Carney, it is used by Akil Stokes, Jason Greystone, and other guys from Trade Empowered and Tier 1 Trading. Okay, well, majority of advanced pattern traders, harmonic pattern traders are using it. What I would calculate right now is the fixed percentage money management. Okay, so what we need to calculate with fixed percentage money management, first we should calculate the risk to reward for each and every trade. And let me explain you my thought. So if you have a risk to reward of 1.2, yes, in this trade, so if you risk 1, you generate 1.2. Yes, if you lose 1, you lose 1, of course. Okay, so this is your risk. If this one equals to 1%, so this one is what? It equals 1.2 multiplied 1%. That's it. That's why you need to know risk to reward. Okay. The risk to reward for target 1 is this. The risk to reward for target 2 is this. So how do we calculate the risk to reward for target 1? Very simple calculation. So the risk to reward equals basically the result divided initial risk. And as you see, initial risk is typed with this 5-digit broken manner. It should be converted into pips. So that's why we divide it by 10. Okay. It is although the initial risk to reward is 1-to-1, you see, initial risk, chart risk, they coincide, it is 1-to-1. It is 0.98 because of spread. So if I switch the spread to 0, it is 1-to-1 again. Yes, you see that? But we have reality. In reality, we have spreads. That's why it is 1-to-1. Okay, the risk to reward for target 2. It is calculated a similar way, but we should take our result for target 2 and we should divide that result by initial risk converted into pips. Okay, so this is 0. You see, 0 trade, 0 result. Now let's expand them to the downside. So you see, our losses, instead of 1, they are slightly more because of that risk. And our winners, our losses, you see, sometimes we have half loss, cutting our loss by half, and because of spread it is slightly more. And our zeros are slightly less than that. So instead of having 2, which is target 2, twice more than initial risk, yes, we have 1.96. And of course they are all very good. You see, half, 1, 1, 2, minus 0, 0, half, 0, 2, 2, when you don't have spread. Okay, perfect. Have spread, do not have spread. Don't have spread. Okay, once we have it, now we can calculate our fixed position size. Let me format this column. Fixed fraction, not fixed position size. This is a fixed position size, this is the fixed fraction. Fixed fraction money management is this: you always use 1% for your account, for your risk, for your stop loss. 1% of your account for your stop loss. So it equals this: your account plus where is the risk? Let us type it here. This would be the risk. 1% of your account multiplied risk to reward of number 1 plus your risk multiplied your risk to reward number 2. Okay, and this is your account plus 1% of what? Of your account, of course, multiplied by your account, of course. Well, this is the formula, but here you have risk to this risk percent, and it should be 0.01. Okay, now you have it calculating, and we have it this way. The red one should be fixed reference. To fix it, we have it this way. Okay, 0.01. If I expand it to the downside, we will see what is the number. Format auto fit column width. So you think it is this. In the end, we generated 678,000. Let's create a graph to have a visual representation of that. So you see that it was 900k, and at some time it was 900k, and of course we can have that large outcome, we can have that large profits, but what was our drawdown? So let's copy this drawdown formulas and paste it here. Let's rename it, and it would be fixed fraction, percent fraction, whatever you call it, yes, of your account at a fixed position, and this one is fixed fraction. And here we're calculating the Z column, Z, then we go to Z, then we go to Z. Okay, so let me fix the formula. Done till the end. Okay, going lower, going higher. This is my drawdown. And what we see with fixed fractional money management, with percentage money management, yes, let's type it this way, percent money management, fixed position money management. You see, percent money management generates this enormous amount of money, and it only has 25% drawdown. The drawdown is less and the outcome is more. Okay, as we want the drawdown to stay closer to 30%, let us slightly increase our risk. Instead of 0.01, let's have 0.01.2 maybe. And it is roughly 30%. 0.01.1. Okay, it is almost 30%, a bit greater. Okay, but the outcome is much more. It becomes even greater. It is more than 1 million generated over the period of these years. Okay, now let's calculate the average annual return and average monthly return for this one, yes? So these were average annual, average monthly. Let me use the color for them, maybe blue color, so I know that they belong to this blue position size management, yes? So they belong to blue. So these blue numbers belong to these blue calculations. and let's calculate our annual. Copy, and I paste them here, and now let's do this fixing. So instead of V we should use Z. Yes, so we use Z and we use Z, and when raising in power for annual we should use years. Okay. Oh, didn't work. Oh, years. Where are our years? Should be Z1. Okay. 2356. Why is it 56? It should be 50. Okay. Let me see the last number. This one is the last number that we have, yes? Copy this. No, don't copy. It should be 2350. Okay. I just need the number of the cell, 2350. And here we should type it similar, 2350. It should be Z. Z should be Z1, and here it should be months. Okay. Okay, so should be color brown, and this one should have color brown. Okay, now this belongs to this, blue belongs to blue. Okay, so to generate that anomalous number of 10,000%, to generate a million if compared to 10,100K, it is 10,000%. So multiplying the count 100 times. You see that? You multiply a count 100 times. To multiply a count 100 times, you simply need to generate 27% annual. Your average annual return should be 27, and your average monthly return should be 2%. That's it. And you will multiply your account 100 times over the period of almost 19 years. So guys, you should think it twice. First of all, you can use these numbers to avoid scammers. I agree that my strategy is not the best on earth, and if some filters can applied, it can be much better. But look at the overall performance after the money management applied. Multiply your account 100 times over the period of 19 years. Have you ever heard about this? Yes, there are guys that do it. Multiply it 100 times. Looks unbelievable, but it is. Okay, over the period of 19 years. But what it takes, what you need an average annual return of 27%. You need an average monthly return of 2%. So if you hear somebody saying that he's doing 50% on average, 50% on average monthly, you see that? Just imagine what would be the outcome if you have 50% on average monthly. Let's calculate it. Why not? Let's calculate. Let us start from 10K. So this is our 50%, 0.5. Yes. So monthly, we multiplied 0.5. So it equals previous account plus 50% multiplied previous account. Yes. So next month we have this, and let me use the fixed AB1. Yes, okay. So what is 19 years? They are 225 months. So just stretch 225 months. 225 months. 240. So where is the number? It is this. 225 months. Look at the number. I will choose it this way. Format cell. Look at the number, guys. Oh, the period of 19 years. Okay, you see? So the guy that is generating 50% every month actually generates this money on account in a period of 19 years. Actually generates this. Let's calculate this number. What is it? 1,000, millions, billions, trillions, quadrillions, quintillions, sextillions, septillions, octillions, nonillions, decillions. I don't know other numbers. I mean decanillion, decdo. This is something unbelievable. There are I don't know if we have that many stars in our galaxy. We don't even have. So this is the guy that is saying he generates 50% on his account every month. Okay, let's not be that skeptical. Let's find the guy who tells you he generates 10% on his account every month. Who says this? Let us see what this guy generates in 20 years. It is a bit less, but still, thousands, millions, billions, trillions, quadrillions, 18 quadrillions, 705 trillions, 162 billions, yes, and 68 millions, 608. So 18 trillions. I don't know anybody having 18 trillions right now. Who is the richest man in the world? In the world? As far as I remember, it was the guy having 75 billions dollars, the richest guy on earth. So if you generate 10% every month, and you are trading for 20 years, let's say you didn't recover withdraw anything, yes, so you are having more money than that guy. So thousands, millions, yes, billions, trillions, 18 trillions, 18 trillions dollars. Oh, it is amazing. So if you hear somebody generating 10% every month, he is a scammer. Why would he need you? Why would he need your money to manage? Why would he need to teach you something or whatever if he generates that large outcome? This one is okay. This one is real. This one is not real. 10% every month. 10% on average. It means that some months he's generating 100%, some months he's generating less than that. 10% every month. This is not real. Just run away when you hear somebody generating this. Okay, back to our portfolio. Obviously, fixed fractional, percentage-based money management is much better than fixed position. So you see that? And it is not based on 100 trades, it is based on thousands of trades. Thousands of trades. Okay. It is not based on something subjective, it is based on objective, automated pattern recognition. Automated. Nothing manual, automated. If there is a pattern and it wins, it wins. If it loses, it loses. If it doesn't complete, it doesn't complete. So you see, never completed. Losing pattern, losing pattern. Winning pattern. Losing pattern here as well. Didn't complete. And so on and so forth. Okay guys, hope you like this video. Hope I inspired you to do your own market research, to find your own methodology to work that. I will post the link to this Excel spreadsheet in the description. You can download it and you can play with numbers. Of course, you can use this Excel spreadsheet simply changing the time, risk, pipsage and pipsage, and insert your own, and you can use it as a journal for your backtesting, as a journal for your real-time trading, and this statistical block will give you all the numbers that you need. It will give you maximal drawdowns, it will give you expectancy, profit factors, and so on. Just download this Excel spreadsheet and use it, simply substituting your own time, initial risk, and chart pipsage, and the rest will be calculated, the rest will be done. And of course, chart pipsage for target 2. If you use one position, then you only need this. If you use 2, then you also need this as well. Okay, percent money management. This is something you need to think about. In my earlier ages, in my earlier times, I was advocating for fixed position size, and just think about it. Yes, so when you use fixed position size, for example, you have a small winner, you have a small winner, yes, you have a small winner, you have a small winner, you have a small winner, and then you have enormous loss. You see that? 1, 2, 3, 4, 5 winners were all neglected, were all wiped out by this enormous loss. So if the pattern will be large or if the pattern will be small, it is an absolutely random coincidence. You never know if it will be large or small, what pattern appears. So you are adding additional random variable into your strategy. Do you need it? Do you want to stay precise, or you want to add additional random variables into the equation? Or you want to leave something to chance, leave something to gamble, to fortune? Or you'd better rely on your own power. Okay, so guys, it is obviously that if you treat, be it a small pattern or be it a larger pattern, you always have 1%, you always have 1% regardless of the size of the pattern. It makes all the patterns equal and you generate much more. So 2 benefits. First, you delete random variables from your equations and you generate much more. So that's why I am advocating for percent money management right now. Maybe in future, when I do a bit more research with some other algorithms, maybe I will change my mind. But for now, this one is obviously something that is better than this fixed position size. Okay, hope you like this video. If so, give me a thumbs up, share this video on social media, and until then, good luck and good trading to you. Hope to see you soon.